Thank you for joining us on the first leg of our Round the World webinar series. This week we're focusing on Europe, and we are lucky to have today two very knowledgeable fund managers to talk us through that. And this session is going to be focused on logistics and the impact that sort of digitalization has had on that sector in Europe. We have Matthew Norris with us today. He's Director of Real Estate Securities at Gravis Capital Partners. And we have Evert Castelein, Fund Manager of Aberdeen European Logistics Income. I'll just maybe have a brief intro to what you both do, and we'll go on from there, if that's okay. Should we start with you, Evert?
Yeah. Good morning, everybody. Thanks for having me. My name is Evert Castelein. I'm the lead fund manager of Castelline, which is an investment trust listed on the London Stock Exchange, with a strategy focusing on logistics, mid-sized big boxes and urban logistics in particular. We are now, we've built a portfolio in the last 4 years since inception, currently looking at total assets under management of around 800 million. 24 assets in total. We've built up exposure in France, Germany, the Netherlands, Spain, and Poland. So yeah, we're an experienced manager of logistics in Europe.
And Matt?
Yeah, hi. Thanks for having me on this show. So I'm Matthew Norris. I'm the investment advisor to two Gravis funds, the VT Gravis UK Listed Property Fund and the VT Gravis Digital Infrastructure Income Fund. Both funds are about investing in next generation real estate, about generating secure, reliable income for our investors. We focus on 4 megatrends: aging population, generation rent, urbanization, and importantly for our discussion this morning, digitalization. So digitalization probably the strongest megatrend out there. We build diversified portfolios. So we're a fund that invests in REITs and real estate operating companies and digital infrastructure companies.
Cool. Okay. So let's start by just framing where we are at the moment. Obviously, everyone knows what's happened in the last couple of years with COVID and the move or the acceleration of online retailing. Do you just want to talk about maybe the past 5 years, because it's a trend that sort of predated COVID? What sort of happened and what effect that's had on the logistics property market?
Yeah, sure. Look, Richard, you're right. The pandemic has accelerated an existing trend. So at Gravis, we define it as we're in the 4th industrial revolution right now. It's a revolution that is all about new technologies. It's about artificial intelligence. It's about the Internet of Things. It's about mobile data. And this 4th industrial revolution has really dramatically changed our lives in all manners. So the way that we work has clearly changed. You know, today we're having this discussion via a Zoom call, and it's broadcast live onto Facebook. The world of the way that we play has changed. You know, we stream movies now, we stream music, and then if you look at the way that we live, and this is important for our discussion about logistics, the way that we live has clearly changed. We're all Amazon shoppers, we're all e-commerce shoppers. The pandemic accelerated the rate of change. More of us became online grocery shoppers. The pandemic and then the mandated lockdowns forced us to become online shoppers, and repetition of those functions has become habit forming. So more of us will stay as online shoppers. So massive mega trend at play out there, really favorable for logistics assets, both urban logistics, what we'll talk about, and big box logistics assets, and indeed the wider digital infrastructure universe. And we may touch upon that the negative has clearly been retail. So retail real estate has had suffered greatly. So the pandemic has accelerated the rate of change towards online shopping. I think there are some brilliant REITs and real estate operating companies across Europe that investors can get access to.
Yeah, totally agree what Matthew just said. I do recognize that as well as a fund manager of a logistic mandate, that a lot of demand is coming from e-commerce players. That's a structural trend, but there is more than that, because in the last 2 years during the lockdowns, we've also seen the impact of COVID-19 on supply chains, especially long distance supply chains, that proved to be quite vulnerable. If one step in that very long distance supply chain is missing, then simply you can't deliver the end product to the place where it needs to be. So what is happening right now is that we see a nearshoring trend, where basically manufacturers are looking at their global footprint and are considering to move back to Europe to make the supply chain shorter and thereby more resilient. And at the same time, we also see companies that are building inventory levels to have more products, so they can absorb these external shocks. And both the trend of building of inventory levels, the nearshoring trend, and on top of that, the rise of e-commerce has led to a situation where supply simply can't keep up with demand. Demand is stronger than supply, new product that's coming to the market. So this is really a story of growth. And just to give you a couple of numbers, I mean, the impact of an e-commerce player on the logistic market is just enormous compared to, for example, a traditional retailer that has a shop in high street, gets product delivered once a week. If you compare that, for example, with Amazon, that is running a very complex business model where they have these very large e-fulfillment centers where parcels are put together. They have these regional warehouses or reverse logistics centers, because 1/3 of the products that are ordered online are sent back. So there need to be quality checks, products need to be repackaged. And you also need to have the last touch in the supply chain, or the so-called last mile delivery hubs, where big lorries are delivering the goods and then smaller vans at the back end are taking care of the city distribution. So it has been calculated that for an e-commerce player, if compared with a traditional retailer, requires 2.5 to 3 times more logistics space. And therefore, I'm saying the market is just expanding. And this is a structural trend. For every billion spent online, there is a need for 1 million square feet extra logistics space. And there are some predictions, for example, from CBRE. They're forecasting that in the next couple of years, the growth in online sales will grow by 300 billion. So if you multiply that number, that means we need 300 million extra square feet of logistics space. I mean, that's just a mind-blowing number. That is the same as 4,000 football fields. So that's the kind of number we're talking about. This is really a very strong growth story.
Yeah. So if we take the UK, because it's safe to say that UK is the most mature market in Europe with logistics. If we take that as an example of what Europe could be, I mean, maybe Matt, if you just want to frame what we've seen in the UK in the last over the last sort of 5 years or so.
Yeah, it's really interesting. What you've seen in the UK is an acceleration. So exactly what we've been discussing, and you can observe it in the statistics out there. So in the UK right now, about 25% of retail sales are online. Prior to the pandemic, we were about 20% of retail sales were online. So the pandemic came along, lockdown came along, we flew up to 35+%. We're settling around 25%. So in 2 years, we have achieved 4 years rate of growth. So a big acceleration, 25% of retail sales are now online. At the same time, touched upon this in the retail real estate sector, a sector that we as a firm avoid. You've seen retailers shifting their business models, pivoting their business models to the online world, as Evert says. I mean, clearly, the online world requires a new type of property, a new type of infrastructure. What you see in the retail space, rents are going down, vacancy is increasing. What you see in the online space more investments. And what's really interesting, and we can discuss the dynamics across Europe, especially in big box warehouses, so the Amazon e-commerce fulfillment centers, the Ocado e-commerce fulfillment centers, those tenants are investing in technology inside the building. So we invest in the owner of the building, you get a reliable rent. The owner invests in automation inside those buildings. The value of the equipment they put in the building is often worth as much as the building itself. So that means they're prepared to sign very long-term leases, 20-year leases, linked to inflation. So for us as an investor, that gives us great certainty, really contractual rental income, great visibility on future growth. In an environment where we're concerned about inflation, it's index linked. So as I look across to continental Europe, and in our digital infrastructure income fund, we invest on a global basis. I think some of these trends that we've seen, increased penetration, that's certainly happening in Europe. We certainly see the penetration rates increasing. They're below the UK. So I think in some countries, some European countries, we'll see them continue for many years to come to march up towards the UK level. I expect the rise of quick commerce, so same day delivery, next day delivery, will have a big impact on urban logistics. So a trend that we've seen in the UK, urban logistics space has shrunk over the last 30 years as we've demolished urban warehouses to build residential. And then over the last decade, the rise of e-commerce has led to an increased demand. So there's a great demand is outstripping supply. We're needing new types of urban logistics facilities. So you're seeing multi-story urban logistics facilities being developed. Give it time, that may come to Europe. What we've witnessed in London, the biggest rental growth across the logistics sector, across big box, across urban, across the cities. The biggest we've witnessed is in urban logistics in London, where Segro recently announced that they saw 20% plus growth in estimated rental value. So really strong dynamics at play here in the UK. Expect it to happen in Europe as well.
Yeah. So what are you seeing, Evert, in Europe? You obviously own a lot of these urban logistics and mid-box logistics sites. What are you seeing sort of rental growth wise and stuff?
Yeah, I have a very clear focus on mid-sized big boxes and urban logistics, because I truly believe that this is the most liquid part of the market where growth expectations are going to be highest. And I mean, the way to look at real estate is, for me, being a fund manager of an income-driven strategy, is I like to have alternatives. And a building, that's always the first question I ask myself, needs to have a second life. So worst case scenario, what happens if the tenant leaves? So that explains my focus on mid-sized big boxes, which has a typical size of between 200 up to 500,000 square feet, where you see a lot of dynamics and a lot of leasing transactions taking place, basically giving you an option at times of maturing leases to negotiate rents up, because probably a couple of tenants would be interested to lease that space. And yeah, I'm trying to build my as much exposure as possible in the category of urban logistics, for a very simple reason, because thanks to the rise of e-commerce, there's a lot of demand for these kind of locations where there's a lot of competition for land already from other land users, for example, from residential. Parcel delivery specialists, they compete with each other on delivery time, so they want to get as close as possible to the end consumer. Housing cost is just a small portion of their overall operating expenses. Transportation costs and labor costs are way more important. So that explains why they want to be here, and that's also explaining why we've seen in the UK, as Matthew just described, strong rental growth. And we think the same is happening right now on the continent. That's slightly lacking the UK, which is a very mature market indeed. But in terms of e-commerce penetration, the continent is slightly behind the UK. That also means that opportunity sits here, I think, because a lot of growth still needs to happen. 53% of my portfolio is urban logistics, and in supply constrained areas is where you will find most of the growth. but that doesn't mean that the ultra big boxes don't have a role to play. I mean, especially with tenants that have heavily invested in the kit that goes inside the building, that's of course important. But I think the number of tenants that can take that space, you can probably count on one finger. So I'd rather have the option with several tenants competing over each other to lease space. That's how you can increase rents.
Yeah.
But Richard, maybe a broader answer to your question. The trends that we've observed in Europe, if you look at the fundamental drivers and why are they applicable to Europe? So e-commerce has done fantastic well. Quick commerce has done very well, because consumers, they want choice, and you get your best choice if you go online. You can see all the products. You get price transparency. You can quickly compare prices across retailers, and then you have the convenience factor, the delivery factor. So those three drivers that have driven the UK to 25% plus e-commerce penetration, I think those are key drivers that will be replicated across Europe. I think the consumer in Europe will also appreciate convenience, price transparency, choice, and so I do think we're going to see increasing demand. I do think stock selection, whether it's investing in REITs like we do, and investing in the best REITs, or for Evert's case, actually buying the best buildings is really important, and investors should certainly be aware of that.
Is there any difference on the continent compared to the UK? Obviously, geographically, the UK is a lot smaller, denser, populated, lots of big sort of cities. In, say, a country like Spain, you've got Madrid and Barcelona as the big sort of hub. Does that make it different in the sort of logistic property market to be focusing on different types of assets?
I think if you want to be a successful manager of logistics, you need to understand what drives demand for logistics space. And I think the logistic market is really an international cross-border play, contrary to, for example, the office market or the retail market. So you need to understand the dynamics and reasons why companies want to be located somewhere. So elements and factors that drive demand for logistics is, first of all, geography. Where are people living? Where is the spending power? Where is its labor? Because most of the times logistics is really labor intensive. Where do you find manufacturing industries? Where do you find infrastructure? For example, seaports, most of the time starting point for large transport corridors, such as the seaport of Rotterdam, for example, the largest seaport in Europe. So you need to understand these kind of dynamics and where companies want to be. And a really good illustration of where companies want to be is by simply looking at the number of lease contracts that have been signed over the last couple of years. And I'm looking at these kind of statistics and think, all right, where is demand materializing? If you look at the absolute numbers, the most active market is Germany, followed by the UK, Poland, and the Netherlands. But per capita, the Netherlands is by far the most active market. It's a small country, but really big in terms of logistics. So the Netherlands, Germany, Poland, and UK are the top four in Europe in terms of logistic take-up per capita. So that's how I look at markets. That's where I want to be, and that's where you find assets that have a second life. If you look in countries such as Spain, where I've built up quite a bit of exposure, then you need to be very selective. So yes, of course, the capital of Madrid, of Spain, Madrid, the third largest city after London and Paris, is where you want to be. That's where you find a large pool of consumers. 6 million people live there. It explains why Amazon has occupied 2 of our buildings in that portfolio that I've recently bought. Or Barcelona, for example. If you just zoom in on Barcelona, very supply constrained market. At east you have the sea, at the west you have the mountains and the protected forest. The city is growing. There's hardly any greenfield location available where you can build logistic warehouse. So that's where you will see and can capture a lot of the rental growth. And that's how we build our portfolios with the local knowledge that you need to have to find these pockets in these markets that are supply constrained. So yes, of course, you can have a few in a country, but it's more important that you have a few on a location where the building sits and the local dynamics. So we're building a portfolio bottom up.
Yeah, Evert, I think you're right. I mean, the local market conditions are hugely important. You know, whenever you're looking at investing in real estate, location is key. So there's a massive digitalization mega trend taking place. There's e-commerce. There's much more. As Evert says, you know, there's changing supply chains, but the location matters keenly. For example, if you're investing in assets in Poland, you get a very low rental growth. So you might get access to assets, but the rental growth is no way as strong as the rental growth that we're observing right now in London and the Thames Valley, where it's a supply constrained market. Demand exceeds the supply, rents are pushing on, and they're the sort of attributes that we like.
Yeah. So that brings us nicely on to sort of rental growth prospects then. Like you said earlier, that London are seeing double-digit sort of rental growth over the last year. Can we expect to see that in certain markets in Europe?
Yeah, it's really interesting. The different dynamics at play, and I think, you know, if you were to make some broad generalizations, the bigger the asset, the more likely it is to be an index-linked lease. So the tenant's going to come in, sign a very long lease for a big building, invest a lot of money inside that building in technology, fulfillment, automation. They want certainty on their rent profile, and so it's most likely to be index linked. Whereas if you look at urban logistics, especially in the UK, where we have open market rent reviews, then you see much stronger demand supply dynamics at play, and rental growth pushing on very high. So, you know, I said about SEGRO, which recently announced their results. London was their strongest growth in estimated rental values, followed by the Thames Valley. If you go to continental Europe, different dynamics at play, so much more linked to indexation. And I guess the question is, can we wean the European occupiers off indexation and reflect more rental growth that happens in the strong dynamics that Evert mentions?
What are your thoughts on that, Evert? I know all of your leases are index linked, which at the moment is good because of inflation running away.
Absolutely, 100%. And I think if we just zoom out over the last 35 consecutive quarters, we have experienced rental growth on the continent. Clearly, demand supply is just really helpful. I mean, 4% vacancy, that means it's at its historic lowest level ever. And in some pockets of the market, there's simply no product available at all. So that's a very important driver for rental growth. But there's also another driver, and that is construction costs. So construction costs, the cost for raw materials, steel, for example, has doubled. The cost for concrete has increased quite massively. So for the developer to put product in the market, of course, the value needs to be higher than the costs to build it. And we're now getting into a position where some compensation needs to come from extra rental growth, because otherwise you can't build out a new building. And we all know that there's a very strong demand. So it comes to a point where basically companies need to accept that rents are going to be much, much higher than what it was before. Just on your question in regards of CPI, I think the continent is generally benefiting from full CPI indexation. Inflation on aggregate in Eurozone was close to 5%. So I think this year for us, there will be a massive impact on our income streams because we can increase the rents accordingly. So in terms of the rental growth expectations that we have, we think that for the next 3 years, rental growth will be above inflation even. For mid-sized big boxes, for urban logistics, it will be even much higher than that. And for the ultra big boxes, we think growth prospects are somewhat lower. But yeah, it is a very strong growth story, that's for sure.
Yeah, I mean, I think that's a key point. Investing in the right type of real estate, investing in logistics real estate, it's growth income, not fixed income. And because we have leases in place, it's contractual income. So for investors, there's great visibility on future income, and it's going to grow. It's likely to grow with inflation, or indeed above inflation.
Yeah, that's it. So as we talked about all of this, obviously investors are flocking to these assets, which has also had an impact on yield. Yield compression has been huge. I mean, it's well, definitely sub 4%, around 3% in some markets. Can it get any lower?
We do believe it will get lower, and yields will get keener. We think for the next couple of years, let's say the next 3 years, we will experience at least another 10% of capital growth, which will be front-loaded. So yes, absolutely, we think that yield compression will continue, because there's really a wall of capital directed towards the market. In the last 12 months, more than 50 billion was invested in the logistic market. That's 3 times higher than what it was 10 years ago. So logistics, it's not difficult to explain why the fundamentals are so strong, because I think everybody can, on a personal basis, relate to it, because we've all started to buy much more online. I mean, that's one of the driving forces behind the success of the sector. So logistics is really on top of investors' wish list, together with residential maybe. Offices, of course, is struggling because we're starting to work from home. The retail is moving online, so the retail sector is struggling as well. So it's really the flavor of the day, and that explains why yields can get keener than where they are today. So yeah,
I think Evert, I think you're right. I mean, certainly, you know, we focus on the next generation of real estate assets, whether that be generation rent, so residential or logistics space. What we're observing is the public equity markets are very happy to invest increasing amounts of capital in the listed companies, supply capital both for them to develop out pipelines of new assets and to buy additional assets. And then in the private equity space, you see the private equity funds buying up portfolios of assets as well. So definitely big demand, public equity markets, private equity markets. And I think Evert's right, there's a rotation taking place out there. You know, people are, investors are wary of retail, and that's likely to persist. Office, you really want to own the best quality, highest quality offices in the best location. And so capital is being deployed into newer assets, into these assets where you've got great visibility on future earnings growth.
And then, as we talked about, we talked a lot about the demand side, touched a bit on the supply side. Obviously, well, not obviously, but a lot of these markets are very supply constrained for various reasons, as you touched upon, residential use and sort of years of industrial and logistics space being lost to that. Planning could come into it as well, restrictions in some countries and regions. What can be done to rectify the supply issue?
Well, I think the listed market is a great place to rectify the supply issue. If you look at the logistics REITs across the whole of Europe, including the UK, you see that they have a fantastic land bank, a fantastic development pipeline. They have the in-house know-how and expertise to develop the new product, the next generation of products. So I think they're part of the solution, and I think that's why equity investors are happy to subscribe new capital to these REITs, because they know that the REITs can deploy the capital well and get a yield enhancement by undertaking new ground-up developments. You can probably get 150 basis points better yield by buying it, by building it and leasing it up over buying it.
So that's something you guys are doing, isn't it, Evert? Sort of on a full funding basis. And
yeah, we're teaming up with the larger developers across Europe in forward funding or forward commitment structures. And I do hear from these developers that for them it's really difficult to find land where they can build. So there's a scarcity of development sites, and you would you can ask yourself the question, why, if this is such a strong growth story and there's so much demand for logistics space, why do we not see a sort of supply shock? But the thing is, to build out a speculative development is quite hard because of the large investment that is required, and banks are not really hungry to finance these because they still have the global financial crisis in the back of their minds. So developers are trying to team up with investors like ourselves to see if we can provide them with the capital and then create an interesting development together. And for me, as a fund manager working for abrdn, which is the second largest real estate investor in Europe, I mean, that gives me the sort of opportunity to close these kind of deals, because reputation is really, really important. Because a developer wants to have security on a deal. They don't want to have a situation where the funding all of a sudden stops during the construction phase. No, they want to have security on the deal and do a quick deal and then focus on the next one. So that's why I was able to find quite a few off-market opportunities without any competition from other investors, where we simply do repetitive deals with developer again and again and again. Yeah, that's really, really helpful to have this kind of network with developers across Europe.
I mean, Richard, it's really interesting when you look at the development pipelines for some of the listed REITs in this space. I mean, they're looking over the next 5 to 7 to 8 years to double their rent roll through undertaking developments of new assets. So I increasingly think that the public equity space owns the best quality assets in this subsector.
That's interesting. And so I mean, we're sort of drawing towards the end of our discussion here. I should have said at the start, if anyone's got any questions for the panel, do put them in on the Q&A, and we'll get to them. But maybe just round it off with sort of your forecast for the sector and returns over sort of the near and medium term, really. What are your thoughts?
Look, for us, within both the UK listed property fund and the digital infrastructure income fund, the logistics megatrend is our biggest exposure in both funds. It's our most profitable exposure. I think the great thing and what our investors like is the dividend yield plus the growth. You know, this is growth income, not fixed income. We're seeing dividend growths of high single digit, low double digit. So yield plus growth going forward, and quite possibly with the wall of capital that's coming, valuation yields could sharpen further.
And Evert, I know you've recently reported sort of 12.5% NAV total return in the last year. What are you thinking sort of going forward?
Yeah, so we're targeting 7.5% total return, 5% distribution. We think that will be achievable also in the next couple of years. Yes, last year was just an excellent performance, double-digit growth. And as I mentioned already a couple of times, I mean, I wouldn't be surprised on the upside in terms of rental growth, which is now really starting to come through in combination with some further yield compression, which will be front-loaded probably in the next 12 to 18 months. We'll see and experience most of that. I think the future of logistics is really bright, which will result in a strong performance. The way I'm adding value to my portfolio as well, and that's really key at the moment, is by focusing on the carbon footprints of our buildings and the ESG angle. So we're putting solar panels to work on our roofs, which is generating additional income and makes assets more liquid. Because this is really something that also tenants and companies have put on top of their agenda. So if you have buildings with strong ESG credentials, then you can maybe increase your rents even more, because the rise of energy cost, for example, is a concern. So if you can buy eco-friendly green energy directly from the roof, that will give your company a competitive edge. So yeah, that's how we work on our portfolio.
Oh, that's cool. Okay. Well, we'll wait to get some questions in, but there is one you touched on it then. ESG obviously moved right up to the top of the agenda. What are the ESG credentials of logistics assets? Obviously, solar panels are an obvious one with the sort of flat roofs and things like that. But are there any other initiatives that can be implemented?
Well, as a standard, I think all our buildings have LED lighting. Of course, ESG, it's a quite broad topic. I mean, lots of people have different definitions of what ESG means to them. For me, what's really crucial is carbon emission. I mean, in 2015, the Paris Climate Agreement was signed with the ambition to keep global warming below 2 degrees. We all know that carbon emission has a large impact on global warming. And we've seen it in the office sector, for example, with buildings that have low energy labels, stranded assets that were impossible to lease out because of legislation. And we think something comparable could happen with logistics. And that's why I've been taking advice on this topic, because I think that should really be the backbone of your ESG strategy. What is the impact of your buildings on carbon emission, and how can you reduce it? So that's exactly the strategy that we're now building around this trust that I'm managing in the buildings, and we take it step by step. I mean, on-site energy generation is one of the things to focus on. So we're putting solar panels to work. That's the low-hanging fruit, and it's having a large impact on the energy efficiency of your building. But you can also think about replacing installations, making them more energy efficient, insulation, for example. So there are different ways of looking at your buildings and how you can improve their ESG performance. At the moment, with Castelline, we're sector leader in GRESB. GRESB is the Global Real Estate Sustainability Benchmark. So that's the way to measure your green performance. But the way it feels to me, we're on a journey. We're taking the first steps now, and we want to be carbon neutral somewhere in the future. And we're in the process of setting a sort of target date when we want to be there. And together with our tenants, which we have interviewed, we know and understand that it's not only important for us, and it's not only the right thing to do, but it's also really important for them. These companies also have their own ESG strategies, and if we just team up together, we know what's happening in the building. We can just improve the performance of these buildings together with them. That's really important to keep them in our buildings.
Yeah, look, I think Evert's right. I mean, I think there's sort of a trinity of factors at play here, especially on the environmental side. So there's great opportunity, and you see in the logistics assets, as you say, Richard, because of these large rooftops. The largest rooftops photovoltaic array is on top of an Amazon distribution warehouse. But with the trinity of forces at play, as Evert says, the tenants want to be in a green building. The providers of public equity, investors like ourselves, want to invest with funds, with REITs.
I was going to ask, how much emphasis do you put on it when you're picking stocks?
Yeah, so it's of key importance, and it's exactly to this point of stranded assets. We want to invest in the highest quality assets, and with management teams that know how to undertake asset enhancement initiatives. So if they've got a building that's lowly rated, they have a plan of how to make it highly rated. They have the skills, the experience, the expertise to make it highly rated. And then obviously the debt capital providers, the banks, are rewarding green buildings with lower financing costs. So a trinity of forces out there, a lot more to be done. I share the concerns about stranded assets. Investors need to be really careful about what is the energy performance certificate rating of the building. And here in the UK, the government set the minimum energy efficiency standard of B by 2030. So if your commercial building is not B rated by then, you won't be able to lease it or release it, which then raises this risk of stranded assets. I think in the listed space, we see the best quality assets, the best management teams already engaging in plans of how to make sure their buildings are environmentally friendly.
And what should investors look out for then in your portfolios? Obviously, you talk about EPC ratings. There's BREEAM as well. What are the others that they should look out for when they're looking at your portfolio?
Yes, there are many ratings out there for us. You know, EP certainly is. You know, when we're talking about Europe, energy performance certificates, and then anything where legislation is going to bite quickly, I think is really important for investors looking for reliable, secure income.
Evert, you guys have quite one of the leaders on this in Europe with a GRESB. Is it GRESB?
Yeah, well, yeah, it's called GRESB. It's a leading indicator worldwide. It's the global real estate sustainability benchmark. That's how you can measure your green performance against the peer group. Castelline is sitting in a peer group with 6 other listed vehicles that are focusing on pan-European logistics, and we're at the moment sector leader. I'm really proud of that. We're really on the front foot when it comes down to ESG, because we understand, coming back to the liquidity point, that yes, you can have a very high quality portfolio right now, but in order to keep it future fit, I think you need to be focusing on ESG, because that is really growing in importance. If I compare it with when I started my career, it was sort of nice to have. Now it's starting to become really a need to have. And I've been to many meetings with investors where I basically ask, well, are you participating in GRESB? And if the answer would be no, then probably we would not be shortlisted anymore. Then they would not be interested in us. So you need to work on that. And yeah, that's what we do with our ESG team.
Cool. Okay. So hopefully we've got a few questions start to come through now. Very topical one. I didn't mention it at the start, but we've got a question on it now. So is there much Russian investment in European commercial property and logistics? And are any thoughts on the implications of the current conflict?
For me, for the implications of the current conflict, the great thing about investing in real estate is contractual rental income. So long-term visibility on income, and as we've said, look, growth income. So as geopolitical uncertainty increases, if you're looking for sort of safe haven assets where you have contractual rental income, then for us, for Gravis, you know, that's a key attraction of investing in real estate and definitely logistics real estate.
Yeah, I think, well, the fundamentals of the sector, the logistics sector, won't change because of this very painful situation in Ukraine. Maybe it will have an impact, of course, on financial markets and the inflation rates with growing energy prices. But with the indexation-linked leases that we're looking at, there's some sort of inflation hedge. So yeah. That is, I think, what will in fact and impact the logistic market, and of course it can have an impact as well on interest rates. But yeah, I'm not going to speculate on that. I've just followed the news this morning, and yeah, we'll take it from there. But I think really relevant for us is that the fundamentals of the sector won't change, and there's the indexation linkage in the leases, so we have that sort of hedge.
Okay. Next question we got. Which European countries do you see as real growth prospects, and which are the ones to avoid?
Yeah, look, when I look at the look-through data on the companies that we invest in, you know, clearly the UK has the highest rate of rental growth. So on average, over the last sort of year, double-digit, low mid-teens. Rental growth is very strong. If you look at continental Europe, as Evert said, look, an indexation market, the lowest rate of rental growth is Poland. We certainly observe higher rental growth rates in France and Germany.
Yeah, if I look at the European market, I mean, I'm a little bit agnostic to where I'm investing. It's more about, well, the urban profile, the location, and the supply constraints. And in that particular situation, I agree with Poland that the rental growth will be probably below European average. It just depends on where in Poland you're investing. So you can't say, well, this applies to the entire Polish market. Again, you need to zoom in on the local situation. For me, what is absolutely key is that, assets that have an urban profile in cities where there's a supply constraint, where there's a lot of competition for land, will just benefit from really strong rental growth, much higher than for the average for the entire sector.
Cool. Is there a fear that online shopping has plateaued or will fall as sort of economies open more? And what impact do you think that will have on demand for logistics?
This is a multi-year mega trend that's in place, the move to online shopping, e-commerce, quick commerce. So certainly the data that we've observed during the pandemic, there was a peak. But even if we plateaued at this level today, we've achieved 4 years growth in 2 years. And if you look back through time, this trend has been taking place for many, many years. So I don't think anything coming out of the pandemic has stopped the march of the internet for all of the reasons. I say that the convenience factor for shoppers, the choice for shoppers, the price transparency for shoppers, that's all in place. The retailers are clearly responding to that. So yeah, sure, we've come off the peaks. Do we reverse a multi-year mega trend? I don't think so. And I think as you look across continental Europe, I think continental European shoppers value the same choice, the same price transparency, the same value propositions as we've seen highly valued in the UK and indeed in North America. That same mega trend of increasing online penetration, and retailers are looking to close their physical stores. They're looking to reduce their footprint.
No, interesting. Cool. Couple of questions here on Europe versus UK. One on rental growth. Why is UK rental growth so much larger than Europe, and is this difference sustainable?
Yeah, so where you see the strongest rental growth in the UK is urban logistics in London. And if you think about London, densely populated city where supply of urban logistics space has shrunk because it's been converted to higher value alternate uses, i.e. residential. But now we have massive increasing demand with entrepreneurs out there coming up with new ideas about quick commerce, about same day delivery leading to increased demand. So demand's going up, supply is constrained. There is a response to that. The REITs are certainly developing the new stock. If you look at it on a rent basis, rent for logistics space is still much cheaper than rent for retail space. So the retailers can afford to take that space. And as Evert said, there are many other occupiers that want space. It's not just about e-commerce. There are many other tenants wanting that space, wanting that same access to the market.
Okay, so do we see?
I think Europe's also lagging a little bit to UK, as I mentioned in the outset. The e-commerce penetration in UK is much higher than for Europe on average, but we can see that the continent is following in UK slipstream, and we see the same sort of growth happening here. So we are really in the early days of that rental growth, and that's why I'm saying the opportunity sits on the continent against the UK, where a lot of growth has already happened. Still a very strong market, a very mature market with strong fundamentals, but we think that a lot of the growth will happen on the continent in the next couple of years, and yeah, we already see it happening on locations where there is no stock available, that operators simply need to accept that the rents from the past are no longer the rents of today. And that's why I'm positioning myself with a focus on urban logistics, where especially in the large cities such as Madrid and Barcelona, or for example in the Netherlands, a very good example where we have high growth expectations as well, because the Netherlands is very densely populated and it's also struggling with EU legislation around nitrogen, which basically makes it very difficult to build close to protected nature and larger cities. So there's a supply constraint over here as well. Giving me as a landlord a good chance to increase rents at maturity.
Cool. And the other one on Europe versus UK is on inflation. Any comments on the attraction of European property versus UK property as an inflation hedge?
Yeah, I mean, there are a couple of differences if we compare the UK with the continent, and indexation is one of them. I mean, the standard lease agreement on the continent has full CPI indexation against the UK, where rents remain flat during your lease until you enter into open market or rental review. So especially today's market, as I mentioned, 5% is the average indexation for the Eurozone. That gives us a sort of a benefit. Another difference is the fact that German banks are really active on the continent. Financing rates are really low. My average cost for the current loan portfolio is around 1.4% on a 7-year tenure. So that's really, really attractive. And I've even signed loan agreements sub 1% in the recent past. So financing costs are way, way lower than in the UK. And by nature, of course, the investable market in Europe, 75% is on the continent, 25% is the UK. So if you're looking to diversify your risk across more markets, then it's easier to be done on the continent where I've invested. These are the differences I can see.
But I mean, it's really interesting that, I mean, this is growth income, so we should observe across the countries, across whether it's urban logistics, whether it's small box, big box, there's going to be rental growth. And then with the fund managers of the REITs and the managers of the REITs deploying financial leverage, and as Evert says, you know, he's getting access to great capital at a very low price. We'll see financial leverage in the business leading to the shareholders and investors like ourselves good growth in dividend per share. We expect to see very strong dividend growth in the years ahead.
Cool. All right. One last question, and it's sort of a negative that probably could be made into a positive. But are there any obstacles that you foresee for the logistics sector going forward? The question here is given an example of talk of tax on online retailers or on online retail sales. What impact do you think that will have, or any other risks that you think there are for the sector?
Yeah, I mean, even if you introduce a tax to the online retailers, if you go back to looking at the cost of the space that they're renting, it's a much lower cost space than a high street space or a shopping mall space. So there's plenty of margin there for them to absorb a tax should one be introduced.
So they won't put that onto the consumer through higher delivery costs and things like that, which could have an impact on online sales.
Well, maybe, but what we've seen, and I think one of the things that I've described, consumers love the fact that they've got choice, they've got price transparency, and they've got convenience. So that price transparency element is very strong. The ability to search across retailers to see who can offer you the best value. So I think that stays in place. Yeah.
You got any thoughts on that, Evert?
Yeah, I think a risk could be rising energy costs. So for companies that are using a lot of energy, that could have a material impact on the businesses and could lead to a potential bankruptcy. That's why it's so important to have an alternative to buy assets that are liquid, that are highly sought after by the market. So that could be one risk factor to consider. Another one could be rising interest rates. For the same reason, of course, companies that are using a lot of debt, that could have material impact on their financials. These are the risks that I see.
Yeah, cool. I thought that was the last question. We just had one more come in on M&A activity in continental Europe. There was a recent takeover approach for VIB. What are your thoughts on M&A activity?
Yeah, look, we see it. So in the two funds in the VT Gravis UK listed property fund, We focus on high quality, low leverage. Well, you know what? Private equity also like high quality assets. They buy the low leveraged assets and deploy more leverage against them. So that fund has been the beneficiary of a takeout of Handstein, you know, a couple of years ago by Blackstone. And then if you look to the Digital Infrastructure Income Fund, that has a high exposure to the logistics megatrend in developed markets around the world. Right now, one of our investments, LXP, a US owner of logistics assets, an activist shareholder there is trying to get trying to acquire the company, and has led to the company's response of a strategic review that may indeed lead to private equity acquiring the whole company. So yeah, definitely M&A is out there. If you've got good assets, investors like ourselves want to invest in the public equity of those, but equally private equity wants to buy them for themselves.
Yeah, from an abrdn perspective, of course, we have announced not that long ago that we have bought 60% of the shares into Tritax, which is, of course, a company quite well known in the UK with their B-Box strategy. They also have the European E-Box strategy. So we've teamed up with them, yeah, creating a large logistic platform within our organization. So yeah, logistics is where we are building our knowledge and where we have our focus.
Yeah, cool. Okay, well, I think that brings us to a nice conclusion. Thank you again for joining us. Hope you found it interesting as I did, the debate. And if you want to hear any more about abrdn European Logistics Income, we have a presentation that Evert kindly pre-recorded for us, which you can see the link in the chat box on here, or you can go onto our website. It's under the events tab and check that out a bit more in depth on the fund. We're back next week, next Thursday, 3rd of March, for the Americas Day. That's kicking off at 2 p.m. So please sort of sign up for that and join us for that. But just leaves me to say thank you, Matthew and Evert, and have a great rest of the day.
Brilliant. Thanks very much.